As10 Accounting for fixed assets. This accounting standard includes paragraphs set in bold, italic, type and plain type which have equal authority. Paragraph in bold, italic type indicates the main principle. This accounting standard should be read in context of the preface to statements of accounting standard and the applicability of accounting standards to various entities. Introduction. Financial statements disclose certain information relating to fixed assets in many enterprises. These assets are grouped into various categories such as land, building, plant, and machinery. Issued in 1995, attention is specific, specifically drawn to paragraph 4.3 of the preface, according to which accounting standards are intended to apply only to those items which are material. Vehicle, furniture, fitting, goodwill, patents, trademarks and designs. This standard deals with accounting for such fixed assets except as described in paragraph 2 to 5 below. This standard does not deal with specialized aspects of accounting for fixed assets that arise under comprehensive system reflecting the effects of changing price but applies to financial statements prepared on historical cost basis. This standard does not deal with accounting for the following items to which special considerations apply: forest, plantations and similar Similar regenerative natural resources, wasting assets including mineral rights, expenditure on the explorations for and extraction of mineral oil, natural gas and similar non-regenerative resources, expenditure on real estate development and livestock, expenditure on individual items of fixed assets used to develop or maintain the activities covered in 1 to 4 above, but separable from these activities, are to be accounted for in accordance with these standards. This standard does not cover the allocation of the depreciable amount of fixed asset to future periods, since this subject is dealt with in Accounting Standard 6 on depreciation accounting. This standard does not deal with the treatment of government grant and subsidies and assets under leasing rights. It makes only a brief reference to the capitalization of borrowing cost and to asset acquired in the amalgamations or merger. These subjects require more extensive consideration that can be given to this standard. Definitions. The following terms are used in this standard with meanings specified. Fixed asset. Fixed asset is an asset held with intention of being used for the purpose of producing or providing goods and services and is not held for sale in the normal course of business. Fair market value is the price that would be agreed to in an open and unrestricted market between knowledge and willing parties dealing at arm's length who are fully informed and are not under any compulsion to transact. Gross book value of a fixed asset is its historical cost or other amount substituted for historical cost in the books of account and financial statements. When this amount is shown net of accumulated depreciation, it is termed as net book value. Explanation. Fixed assets often comprise a significant portion of the total assets of an enterprise and therefore are important in the presentation of financial position. Furthermore, the determination of whether an expenditure represents an asset or an expense can have a material effect on an enterprise reported results of operations. Identification of fixed assets. The definition in paragraph 6.1 gives criteria for determining whether items are to be classified as fixed assets. Judgment is required in applying the criteria to specific circumstances or specific types of enterprises. It may be appropriate to aggregate individually insignificant items and to apply the criteria to the aggregate value. An enterprise may decide to expense an item which could otherwise have been included as fixed assets because the amount of expenditure is not material. Standby equipment and servicing equipments are normally capitalized. Machinery spares are usually charged to the profit and loss statement as when consumed. However, in such spares can be used only in connection with an item of fixed asset and their use is expected to be irregular. It may be appropriate to allocate the total cost on a systematic basis over a period not exceeding the useful life of the principal item. In certain circumstances, the accounting of an item of fixed asset may be improved if the total expenditure thereon is allocated to the component parts, provided they are in practice separable and estimates are made of the useful lives of these components. For example, rather than treat an aircraft and its engine as a unit one, it may be better to treat the engine as separate unit it, if it is likely that their useful life is shorter than that of aircraft as a whole. Components of cost. The cost of an item of fixed asset comprises its purchase price including import duties and other non-refundable taxes and levies and any directly attributable cost of bringing the asset to its working condition for its intended use. Any trade discount and rebates are deducted in arriving at the purchase price. Examples of directly attributable costs are site preparation, initial delivery and handling cost, installation costs such as special foundations for plant and professional fees, for example fees of architects and engineers. The cost of fixed asset may undergo changes subsequent to its acquisition or construction on account of exchange fluctuations, price adjustments, changes in duties and similar factors. Administration Administration and other general overhead expenses are usually excluded from the cost of fixed assets because they do not relate to a specific fixed asset. However, in certain circumstances, such as expense as are specifically attributable to construction of a project or to the acquisition of a fixed asset or bringing it to its working condition may be included as part of cost of construction project or as a part of cost of fixed asset. The expenditure incurred on startup and compensation of the project, including the expenditure incurred on test run and experimental production, is usually capitalized and as an indirect element of the construction cost. However, the expenditure incurred after the plant has begun commercial production, that is, production intended for sale of captive consumption, is not capitalized and treated as revenue expenditure even though contract may stipulate that the plant will not be finally taken over until after the satisfactory completion of the guarantee period. In the interval between the date of project is if the interval between the date of a project is ready to commence commercial production and the date at which commercial production actually begins is prolonged, all expenses incurred during the period are charged to the profit and loss statement. However, the expenditure incurred during this period is also sometimes treated as deferred revenue expenditure to be amortized over a period not exceeding 3 to 5 years after the commencement of commercial production. It may be noted that paragraph relates to all expenses incurred during the period. This expenditure would also be would also include borrowing cost incurred during the said period. Since accounting standard AS16 borrowing cost specifically deals with treatment of borrowing costs, the treatment provided by AS16 would prevail over the provisions in respect combined in this paragraph, as these provisions are general in nature and apply to all expenses. Self-constructed fixed assets. In arriving at the gross book value of self-constructed fixed asset, the same principle apply as those described in paragraph 9.1 to 9.4. Included in the gross book value or costs of construction that relate directly to the specific asset, and costs are attributable to the construction activity in general and can be allocated to specific assets. Any internal profits are eliminated in arriving such cost. Non-monetary consideration. When fixed asset is acquired in exchange of another asset, its cost is usually determined by reference of fair market value of the consideration given. It may be appropriate to consider also the fair market value of the asset acquired if this is more clearly evident. An alternative accounting treatment that is sometimes used for an exchange of asset, particularly when assets exchanged are similar is to record the asset acquired at the net book value of the asset given up. In such case, an adjustment is made for balancing receipt or payment of cash and other consideration. When fixed asset is acquired in exchange of share and other securities in the enterprise, it is usually recorded at its fair market value or fair market value of securities issued, whichever is more clearly evident. Improvements and repairs. Frequently, it is difficult to determine whether subsequent expenditure related to fixed asset represents improvements that ought to be added to the gross book value or repairs that ought to be charged to the profit and loss statement. Only expenditure that increases the future benefits from the existing asset beyond its previously assessed standard of performance is included in the gross book value. For example, an increase in capacity. The cost of an addition or extension to an existing asset which is of a capital nature and which becomes an integral part of existing asset is usually added to its gross book value. Any addition or extension which is which has a separate identity and is capable of being used after the existing asset is disposed of is accounted for separately. Amount substituted for historical cost. Sometimes financial statements that are otherwise prepared on historical cost basis include part of all fixed asset at a valuation in substitution for historical cost, and depreciation is calculated accordingly. Such financial statements are to be distinguished from financial statements prepared on a basis intended to reflect comprehensively the effects of changing prices. A commonly accepted and preferred method of restating fixed assets is by appraisal, normally undertaken by competent valuer. Other methods sometimes used are indexation and reference to current price, which when applied are cross-checked periodically by appraisal method. The revalued amount of fixed assets are presented in financial statements either by restating both the gross book value and accumulated depreciation so as to give a net book value equal to the net revalued amount, or by restating the net book value by adding therein the net increase on account of revaluation. An upward revaluation does not provide a basis for crediting to the profit and loss statement the accumulated depreciation existing at the date of revaluation. Different bases of valuation are sometimes used in the same financial statements to determine the book value of the separate items within each of the categories of fixed assets or for the different categories for fixed assets. In such cases, it is necessary to disclose the gross book value included on each basis. Selective revaluation of assets can lead to unrepresentative amounts being reported in financial statements. Accordingly, when revaluations do not cover all the assets of a given class, it is appropriate that the selection of assets to be revalued be made on a systematic basis. For example, an enterprise may revalue a whole class of assets within a unit. It is not appropriate for the revaluation of a class of assets to result in the net book value of that class being greater than the recoverable amount of the assets of that class. An increase in net book value arising on revaluation of fixed assets is normally credited directly to owner's interest under the heading Revaluation Reserves and is regarded as not available for distribution. A decrease in net book value arising from revaluation of fixed assets is charged to profit and loss statement except that to the extent that such a decrease is considered to be related to a previous increase on revaluation that is included in revaluation reserve. It is sometimes charged against that earlier increase. It sometimes happens that an increase to be recorded is a reversal of a previous decrease arising on revaluation which has been charged to profit and loss statement, in which case the increase is credited to profit and loss statement to the extent that it offsets the previously recorded decrease. Retirements and disposals. An item of fixed asset is eliminated from financial statements on disposal. Items of fixed assets that have been retired from active use and are held for disposal are stated at the lower of their net book value and net realizable value and are shown separately in financial statements. Any expected loss is recognized immediately in the profit and loss statement. In historical cost financial statements, gain or losses arising on disposal are generally recognized in the profit and loss statement. On disposal of a previously revalued item of a fixed asset, the difference between net disposal proceeds and the net book value is normally charged or credited to the profit and loss statement except to the extent such as loss is related to an increase which was previously recorded as a credit to revaluation reserve and which has not been subsequently reversed or utilized. It is charged directly to that account. The amount standing in revaluation reserve following the retirement or disposal of an asset which relates to that asset may be transferred to general reserve. Valuation of fixed assets in special cases. In the case of fixed assets acquired on hire purchase items, although legal ownership does not vest in the enterprise, such assets are recorded at their cash value, which is not readily available, which, if not readily available, is calculated by assuming an appropriate rate of interest. They are shown in the balance sheet with an appropriate narration to indicate that the enterprise does not have full ownership thereof. When an enterprise owns fixed assets jointly with others, otherwise than partner of a firm, the extent of that its shares in such assets and the proportion in the original cost accumulated depreciation is written down are stated in the balance sheet. Alternatively, the pro rata cost of such jointly owned assets is grouped together with similar fully owned assets. Details of such jointly owned assets are indicated separately in the fixed asset register. Accounting standard AS19 leases come into effect in respect of asset leased during the accounting period commencing on or after 1/4/2001. AS19 also applies to asset acquired on hire purchases during accounting periods commencing on or after 1/4/2001. Accordingly, this paragraph is not applicable in respect to assets acquired on hire purchase during accounting periods commencing on or after 1/4/2001. When several assets are purchased for a consolidated price, the consideration is appro- apportioned to the various assets on a fair basis as determined by competent valuers. Fixed assets of special types. Goodwill in general is recorded in the books only when some consideration in money or monies worth have been paid for it. Whenever a business is acquired for a price payable either in cash or in shares or otherwise, which is in excess of value of the net assets of the business taken over, the excess is termed as goodwill. Goodwill arises from business connections, trade names, trade name or reputation of an enterprise, or from other intangible benefits enjoyed by an enterprise. As a matter of financial prudence, goodwill is written off over a period. However, many enterprises do not write off goodwill and retain it as an asset. Disclosures. Certain specific disclosure on accounting of fixed assets are already required by Accounting Standard 1 on disclosure of accounting policies and Accounting Standard 6 on depreciation accounting. Further, disclosures that are sometimes made in financial statements include gross and net book values of fixed assets at the beginning and end of an accounting period, showing additions, disposals, acquisitions, and other movements. Expenditure incurred on account of fixed assets in the course of construction and acquisition, and revalued amount substituted for historical cost of fixed assets. The method adopted to compute the revalued amounts, the nature of any indices used in the year of any appraisal made, and whether an external valuer was involved in case where fixed assets are stated at revalued amount. Main principles. The items determined in accordance with the definition in paragraph 6.1 of this standard should be included under fixed assets in financial statements. The gross book value of a fixed asset should be either historical cost or a revaluation computed in accordance with this standard. The method of accounting for fixed assets included at historical cost is set out in paragraphs 20 to 26. The method of accounting of revalued assets is set out in paragraph 27 to 32. The cost of fixed assets should comprise its purchase price and any attributable cost of bringing the asset to its working condition for its intended use. The cost of self-constructed fixed asset should comprise those costs that relate directly to the specific asset and those that are attributable to the construction activity in general and can be allocated to the specific asset. When a fixed asset is acquired in exchange or in part exchange for another asset, The cost of the asset acquired should be recorded either at fair market value or at the net book value of the asset given up, adjusted for any balancing payment or receipt or cash or other consideration. For these purposes, fair market value may be determined by reference either to the asset given up or to the asset acquired, whichever is more clearly evident. Fixed asset acquired in exchange for shares or other securities in the enterprise should be recorded at its fair market value or the fair market value of the securities issued, whichever is more clearly evident. Subsequent expenditures related to an item of fixed asset should be added to its book value only if they increase the future benefits from the existing asset beyond its previously assessed standard of performance. Material items retired from active use and held for disposal should be stated at the lower of their net book value and net realizable value and shown separately in the financial statements. Fixed assets should be eliminated from the financial statements on disposal or when no further benefit is expected from its use and disposal. Losses arising from the retirement or gain or losses arising from disposal of fixed asset which is carried at cost should be recognized in the profit and loss statement. When a fixed asset is revalued in financial statements, an entire class of assets should be revalued on the selection of assets for revaluation should be made on a systematic basis. This basis should be disclosed. The revaluation in financial statements of a class of assets should not result in the net book value of that class being greater than the recoverable amount of assets of that class. When fixed asset is revalued upward, any unaccumulated depreciation existing at the date of revaluation should not be credited to the profit and loss statement. An increase in net book value arising on revaluation of fixed assets should be credited directly to owners' interest under the head revaluation reserve, except that to the extent that such increase is related to and not greater than a decrease arising on revaluation previously recorded as a charge to the profit and loss statement. It may be credited to the profit and loss statement. A decrease in net book value arising on revaluation of fixed asset should be charged directly to the profit and loss statement, except that to the extent that such a decrease is related to an increase which was previously recorded as a credit to revaluation reserve and which has not been subsequently reversed or utilized. It may be charged directly to that account. The provisions of paragraph 23, 24 and 25 are also applicable to the fixed assets included in financial statements of at a revaluation. On disposal of a previously revalued item of fixed asset, the difference between net disposal proceeds and the net book value should be charged or credited to the profit and loss statement, except that to the extent that such a loss is related to an increase which was previously recorded at a credit to revaluation reserve and which has not been subsequently reversed or utilized. It may be charged directly to that account. Fixed assets acquired on hire purchase terms should be recorded at their cash value, which, if not readily available, should be calculated by assuming an appropriate rate of interest. They should be shown in the balance sheet with an appropriate narration to indicate that the enterprise does not have full ownership thereof. In case of fixed assets owned by the enterprise jointly with others, the extent of the enterprise shares in such assets and the proportion of the original cost, accumulated depreciation and written down value should be stated in the balance sheet. Alternatively, the pro see footnote 3 rata cost of such jointly owned assets may be grouped together with similar fully owned assets with an appropriate disclosure thereof. When several fixed assets are purchased for a consolidated price, the consideration should be appropriate apportioned to the various assets on a fair basis as determined by competent vendor should be apportioned on various assets on a fair basis as determined by competent valuers. Goodwill should be recorded in the book only when some consideration in money or money worth has been paid for it. Whenever a business is acquired for a price, payable in cash or in shares or otherwise, which is in excess of the value of goodwill of the net assets of the businesses taken over, the excess should be termed as goodwill. Disclosure: the following information should be disclosed in the financial statements: gross and net book value of fixed assets at the beginning and end of the accounting period, showing additions, disposals, acquisitions, and other movements. Expenditure incurred on account of fixed assets in the course of construction or acquisition, and revalued amounts substituted for historical costs of fixed assets, the methods adopted to compute the revalued amounts, the nature of indices used, the year of any appraisal made, and whether an external valuer was involved. In cases where fixed assets are stated at revalued amounts.